Okay, hello everybody. This is Brian Terry and Eric O'Rourke is on as well. This is going to be a new feature we're going to do in the group here, and it's just a weekly training session, question and answer kind of thing. And I'm going to add a few more people in. And okay, so today I wanted to share with you guys a strategy that to me it's a lot of fun. This is a fun strategy, and it's kind of a different twist on the covered call. And so I've been posting these a lot in the Alpha Trading Group, and so far this year they've done really well. But it's on diagonal spreads. And again, if you guys have questions, you can either type them in the chat or just unmute yourself and ask away. It's very informal. So, okay, so let's just start with a quick definition. Um, what is a diagonal spread? So really, the simple definition is it's a spread where you're buying a call and you're selling a call, but you're using different expirations and you're using different strikes. And what it does is it enables you to set up either a bullish trade or a bearish trade if you like. Um, and and it's kind of I always kind of like to equate it as like a leveraged covered call. So it's a really relatively simple strategy in that you're just buying a call and selling a closer dated call. So we go out, uh, out into the future, either 60, 90, whatever length of time you want to do it. And then you sell closer calls similar to selling a covered call. So the long option enables us to sell calls against it similar to a covered call. So if we bought 100 shares of Apple, we could sell one covered call for every option. If we buy a long call in Apple, we could still sell calls against it. So it's again, it's very similar to a covered call, except instead of owning the shares, we actually buy a long dated call. And what this does is it enables us to, do a trade very similar to a covered call, but it's a lot less capital at risk. So if we bought, 100 shares of Microsoft and it costs $300 a share, that'd be $30,000 to buy 100 shares. We could buy a long call for a fraction of the cost and be able to sell calls against it. So one thing I would say is if you look up, like poor man's covered call or diagonal spreads, you will probably see almost an infinite number of variations to the strategy. Some people go out a year, some people go out 6 months, some people go, any length of time. Some people do them 1 month at a time. Um, and they'll buy different strikes. They'll buy deep in the money, out of the money, at the money, and there's really nothing wrong with any of those options. It's just it's the same strategy, just a couple of different twists. And it really kind of depends on how, if you're extremely bullish in a strategy, then you might want to go deeper in the money. If you're looking for income like I am on these kind of trades, I tend to go a little further out of the money. But there's lots of different variations. What I'm going to show you is how I do them. And again, if you like the strategy, but you don't like my setup, then you can just kind of tweak it to what fits you best. Does that make sense, everybody? Okay, so what I do is when I look at a stock that's in a bullish pattern and I want to do a poor man's covered call or a diagonal spread, I'm looking to buy a call strike that has an expiration of 45 to 60 days out. So that's about as far as I will go. And like right now, I'm starting to look at like the March monthly paper when I'm selling, um, when I'm buying my call. And I generally look between the 35 and the 40 delta strikes. And what that does is it reduces the cost of the trade. Plus, it still enables you to take advantage of it when the stock goes up in price. And then, so when I'm looking at that 35 to 40 range, I'm looking to see which strike within there has the greatest amount of open interest. So that's how I select my long strike. Nothing fancy, just looking for a good surrogate or synthetic stock price. And then I go out and I look to sell calls against that long call, either 7 to 14 days out. So I'm not going, less than a week, and I'm not going more than a couple of weeks. And I use the strike that is just outside the expected move. So again, I'm buying a call 45 to 60 days out into the future, and then I'm selling a call 7 to 14 days out. And again, I'm looking in the long side, 35 to 40 delta. And on the short side, it's whatever strike is just outside that expected move. And if I'm like right on the bubble, I'll just go out a little further. Any questions so far? Okay. So here's just I just while I was working on this, I was looking at some addition, some candidates into the future for this kind of strategy, Crowd, Zscaler, Elf, Shop, CRM, PanW. There's just a couple that kind of came across my radar while I was doing some research. In terms of like what I'm looking for in the candidate, if it's in that $150 to $300 range, that's kind of the perfect candidate for me to, do a cover call. If it's under, 150 or something like that, I will look to maybe buy the call. I mean, do it as a cover call. So that's kind of the way I um, set up my criteria. I'm looking for a little bit higher price stock so I can take advantage of the leverage. So once I put the trade on, my rules in terms of managing them are pretty basic. If the stock moves up to my short strike when it's close to expiration, I'll close the trade. I'm looking for about a 30% return on risk is my profit goal. So that's kind of my what I'm looking for when I start the trade. Now, if the stock moves down, um, I look to roll my strikes, and I will generally roll if I've captured between 80 and 90% of the credit. So if I get $1 for the credit for the short call and it's down to 20 cents or less, I'm thinking of rolling that call out. And I generally roll them 1 week at a time. And so the other thing that's really interesting about this strategy is that even though it functions as a covered call in a lot of ways, it's not, in that if your short strike goes in the money, they won't take your shares away. You'll actually be short of the whatever strike you have. So what you want to make sure is that your strikes don't go in the money, um, or you may be assigned. So you just have to keep an eye on that. Um, and again, it acts like a cover call. It works like a cover call in a lot of ways, but they're actually two separate trades. And one thing that I've learned on this strategy is that you have to be really patient, because a lot of times, the stock will move against you and you want to take some kind of action. But what I found is if you stick to your rules and say, like if my credit is higher than, the 20%, I'm not rolling it yet. If it's less than that, then I am rolling it. And if I can get my 30% return on risk, then I take my profits and I look for a new trade. So, any questions on any of those rules or how I do them? Okay. So that's how I do the trades. And let me say, so here's an actual trade that I put on just a while ago. So this was in posted in the Alpha Traders Club, and it was a trade that I put on in Microsoft. So the stock was trading at $372.90. And this trade was on November 20th. So that's when when I put the trade on. So it was trading at 372. So I went out and bought a January 390 call. So again, um, it's November 20th. I bought a January call and I bought the 390, which was out of the money, and I paid $7.01 for it. And then at the same time, I sold the November 24th 385 call, and they paid me $1.96. So my net debit on the trade was $5.05. So that was the initial trade. And then 7 days later, the stock had moved up in price. So I was able to close the whole trade out for $6.50. So I made $145 per contract in 7 days, which was a 28.7% return on risk. So that's kind of as simple as the trade can be. So that's so that's just an example of the kind of trades that I like to make using this poor man's covered call. So George had a question. The PMCC it stands for poor man's covered call. And it really is just an acronym. If instead of buying 100 shares, like in this particular case, if I'd bought 100 shares of Microsoft, it would cost about $37,000. I was able to put on this trade for $650 or $500 per contract. And so if I roll the strikes out, I generally roll them out 1 week. And sometimes I will adjust it to slightly outside the expected move. So we just want to, we don't want to have this go in the money, but we want to get as much credit as we can to make it worthwhile. So that's kind of that's just one example. So here's one I just put on yesterday. So this was a trade in SMH so it was PMCC, poor man's covered call. And again, I put this trade on yesterday and I used the March 175 call, and let's see, I bought the 175 call using the March 15th expiration and paid $652 per contract. So SMH is trading for about $173 a share. So we really control 100 share or equivalent of 100 shares for a fraction of the cost. And then I sold the 177 expiring next week and got 92 cents. So the net debit is 560 for the trade. So I put that trade on yesterday. Right now it's at $6. So it's already up a little bit in 1 day. So so that's a current trade that we just put on in the group. So any questions about the SMH trade? That makes everything make, and I put a copy of the chart up to just show you that I was looking that, it had kind of done a bullish reversal, but it still had a little room to run to to get to previous highs. So that was kind of the thought process. Um, and again, the short strike that I used was January 19th in this case. So not this Friday, but next Friday is when it will expire. So that's kind of the way I like to set them up, because a lot of times if you're doing it in less than a week, you just don't get enough credit to really be worth your time. So I like to go out at least a week, to the next week. And but I like to look for stocks that have good that offer weekly calls as well. Those tend to work better because it gives you more options to selling. So here's just some random thoughts on this strategy. And then, if you have any questions, I definitely want to answer them. So I think one thought is, like, this is how I do my poor man's covered call or diagonal call. So if you like the strategy, but you don't like my rules, find a variation that works for you. I think that's important. You don't have to do them exactly like I do it. Um, I like the way I do it. I think it works well for me, but it may not work for your goals. And then I like stocks that are in a bullish trend or a bullish reversal that have some room to run. So what I don't like as much are stocks that they're in a bullish trend, but they're at all-time highs, because then, will you see a reversal when it hits resistance level? So I love it, when we saw that, some of our favorite stocks pulled back the first week in January, because now I know that, that they could easily get back up to that same level. The other thing that I like to do when I'm looking at trades and trying to compare different ones is I want to calculate how much credit I need to collect per day to recoup the cost of the trade. So, for example, on the SMH trade, I'm just going to look it up real quickly. Okay, so I paid $6.52 per contract on that, and I had about 67 days. So I know that if I'm going to totally recoup the cost of my trade, I need to be able to sell for about 10 cents a day, 70 cents a week over that period of time, and I'll have totally covered the cost of my trade. So if the stock doesn't go up and I can write off enough collect enough credit, I can totally reduce the cost in that trade. So yeah, so that is to me, if I'm looking at them and I'm saying, okay, this one has it's 5 cents a day to recoup it, and I can get, well over that in a week, then that trade's more attractive than one that has a much higher recoup rate, if that makes sense. And then in terms of rolling, what I've learned over the time is that the biggest question most people have is, when do you roll your short strikes? You put the trade on, the stock doesn't move, within that first week, and your short strike is, could be almost down to, be worth nothing. You might have got $1, it's down to 15 cents. So when do you roll it? And again, I use the 80 to 90% rule, because if it's at 50%, then I'm kind of leaving more money on the table. So, and it really, if it goes, for me, it makes it a lot easier. I just look at what I got credit for, what it's down to, and then I know it's either time to roll it or close the trade out. The other thing that I would say is, and I hear this a lot from people, is not to be too aggressive in when you're selling your calls. So if you're looking at what the expected move is, make sure you're selling that call just slightly outside that expected move. It's really tempting to sell a closer to the money call, get a lot of credit, but then you're struggling when the price goes through your short call. And remember, we make our money on on the long call, not really the short call. So that's the one that's going to be the money maker. So you want to use the short call to reduce your basis, but not be too aggressive. If that makes sense. Okay. Um, and as a recap, there's lots of variations to this strategy. Um, and it's a great strategy. It's one of my funnest strategies, and it's a great bullish trade strategy. I like, instead of poor man's covered call, what I really like is to refer to it as a leveraged covered call. That it's you have all the advantages of the covered call, except for you don't get dividends, but you're paying a fraction of the cost, and you pretty much get the same appreciation. Um, so that's, and it can also be a bearish strategy. So if you're bearish on a particular stock or ETF, you can do this as basically a covered, a diagonal put spread, where you do it the same way. You're buying a further out put, and then you're selling puts against it. So it's a great way to also go bearish, if that's your thesis on a particular stock or ETF. Has low capital requirements. Like, for example, the trade I did on Microsoft, I think it was about, $500 per trade. So, I could put, three or four of those on for way less than buying 100 shares of Microsoft. And it's basically a defined risk trade. If you stay within your strikes, it's going to be a defined risk trade. So you know that if you don't do anything, how much you can win and how much you have at risk on the trade. And then again, it's similar to a covered call in that you have one long position and you're selling calls against them, but it's really two separate trades. So you just have to keep that in mind. And we wouldn't be eligible for dividends. What I always say on this strategy is that it is um, uh, um, that it's all about, what is your net debit in the trade. So if you put a trade on and you pay $10 for it, your win is based on, is your total credits more than the $10 you paid for the trade. So that is um, something to keep in mind. So a lot of times when I post trades that are like, hey, I've adjusted this trade, my new uh, basis in the long call is $5. That's what's really going to drive how much money you make on the trade. And yeah, the other question was, let's see, you make money on the long call. Yeah, you make money on the long call because if you buy the long call and the stock goes up like you hope, that's what's really going to, most of your appreciation is going to be there. Your short call, what it really does, it just reduces the basis in the stock. So I hope that helps. And let's see what else. So the other thing is, I like it in that it's a very scalable strategy. That, if you say, I really like the strategy, but I'm brand new at it, just do one contract. And you can kind of play with it and go forward there. Eventually, what you'll want to do is you'll want to have in your trading plan, you want to say, I'm going to spend X amount of dollars for every four-man cover call or every diagonal that I do. So for example, if you said, like, I want to have $1,000, I'm going to put $1,000 in each trade. Some trades may only cost you $300. So you would do three contracts. Some of them are going to cost you $800. So you would do one contract. That helps me to kind of say, I'm not really worried too much about the cost of the trade because I'm generally investing the same amount of capital per trade. And Eric pointed out that the short call also reduces your theta in the long call too. So right. So what you're doing is, you have your shorter dated options have much greater theta than your longer dated options. So thanks for that, Eric. So it's very scalable. So if you said like, hey, I just want to do one contract, that's great. If you wanted to put, a bigger amount of capital, you can do 5 contracts as easy as you can do one. And usually the stocks that I like to pick are stocks that have enough open interest. They're big enough name stocks that they're going to move and that you can, excuse me, get in and get out of them without any trouble. But you do need to manage the trade. You want to make sure what's the price of the stock and what's the where's your short call at and things like that, and how what your current basis is. Um, so anyway, um, I'm not sure what I'm going to just say not now. So I think, George, are you asking if we're going to make a copy of this video? If you are, yes, we recorded it, or we are recording it, and so I'll send that along with all the slides. So anyway, so that are all my slides on this strategy. I think it's a fun strategy. Craig wanted to know what the guidelines for closing a trade are. Great question. What I generally will do is try to close both legs at the same time. That's the easiest way to do it. So that way, if it starts to move, you're going to get filled. If I have to do it individually, I'm going to close the short leg first, then the long leg. You can't, most brokers won't let you do it the other way because then you'll have a naked call. So my preference is to do them both at the same time, or close the short and then close the long. So great question. Any other questions or feedback? Has this been helpful? George said, could you take the SMH trade today? I think you could. I mean, I just put it on yesterday. So, and on that one, do you want to see what the alert looked like? I'll go back to that just so you can see. So here's the actual the alert that I put out yesterday, and there was a great question. How do you know what the expected move is going to be? And what I do is I look at the option chain, and on the far right, it will tell you, what the expected move is. And like in this particular case, it's plus or minus 4.93, 5 points. So from today's points, I would add 5 points to that. So in this case, I would probably change my call to the 178 call. But and again, these are, I mean, there's a ton of these. They're always you can always find a good one. The other thing that I didn't mention, I don't like to do these through earnings. So if you have a stock that has earnings in a couple weeks, I generally shy away from them or just wait till the earnings to pass. So I just don't want to have to deal with holding these through an earnings. Yeah. So yeah, the estimated move is on the option chain with the orange bar in tastytrade. So and the other way, if you didn't know what it was, you could actually look at the current price on the option chain, the at the money price, and just add what the put and the call is. That's like a quick way of doing it if you couldn't find the expected move. So like in this one, the estimated move, just looking at the option chain, is about 2.8 and 2.5. So pretty close to what they come up with. So so you could, if you just had to, you could just use that. Just take, what the the at the money put is going for and the at the money call, that's a good way of telling what your expected move is. Another way is to look at what is the one standard deviation move. That's also a pretty good gauge. So anyway, hope that clears it up. And again, once I'm setting those calls, I want to make sure I'm selling them just outside that expected move. If you have to err on which way you go, just go further out. Okay. Any other questions? Okay. Well, appreciate the questions. If you guys have any other questions, I am in Eric's group. So, you can send me a note, a chat through there. If you like these trades and want to test out the Alpha Trading Club, these are trades that Eric and I put on. Eric does a ton of really good, a lot of really good SPX trades. And I do in the money covered calls and these diagonal trades. So one other question that said, what do you, when you close the short call, if the price moves, what I will generally do is I tend to, if the price moves against me and is approaching or just going through my short call, I will roll it out a week and try to roll it up if I can get additional credit. So that's kind of the art of managing them. And one in the group, what I'll do is I put all my adjustments to the trade in there. Okay. Well, I appreciate you guys jumping on. I know it's a busy day, a lot of movement today, up and down. So thanks for jumping on. And let me say there was one more. Okay. So it's
yeah. Thanks, Brian. We appreciate the tutorial, and I know we're going to try to do these more frequently. So just keep a lookout in the everyone group on the website, the stockmarketoptionstrading.net, and we'll post the events there. We'll try to give you a week or so notice, and we may play around with different times of day, because I know not everyone can make it during the day. We might maybe do one at night here and there. If you have any suggestions or recommendations on topics or times, that kind of thing, feel free to comment in the network. So, all right. Thanks, everybody. Thanks, Brian.
Thank you. And we'll see y'all later.